Hello, everybody, and welcome to our weekly market update call for the week of Monday, October the 12th, 2020. I'm Jay Gragnani, and here joining me this week is Ian Saunders. And markets continue to push forward as we continue to see the month of October play out, almost halfway through the month of October. And, we've talked in the past about obviously the market coming off of the month of September, which is historically a weak month for the market. We saw a bit of volatility creep back into the market in the month of September. Turn the calendar to October, which historically October is a month that has generally been positive for the market as it's averaged gains, going back in history. There's obviously been a number of very notable events that have taken place over the years, like October of '87 and obviously October of '08. Nonetheless, the market has, over the course of the past few weeks, really the last few days of September, the first part so far of October has been generally positive for the market. As we look at a chart of the S&P 500 as a gauge of looking at what the market has done, and obviously the overall trend of the S&P 500 remains positive, as is the case with the majority of stocks in the S&P, and we'll talk a little bit more about that in a minute. But after September's bout of volatility, we saw the S&P 500 chart return to a buy signal at 3340. That has continued to push higher with today's action. As we're recording this, the market's up over 1% today and pushing up to 3,500. Breaking through some resistance that had been formed right around 3420. And so now as we look at the S&P 500 chart and looking at next levels of resistance, we're looking back now to the now all-time high, which is back on the chart at 3580 for the S&P 500. And so when we look at the market from here, as we look back towards, obviously we've seen a very quick move higher. In terms of just general support, you've got some support down near term, not showing up here on this chart, but near term, right around the middle of the 10-week trading band for the S&P 500. So right in the 3390 area, there's some near-term support, 3330 to 3390. There's going to be some near-term support in that area. Otherwise, you've got some support further down around 3220, and then even further around 3120 to 3140, all of that still being within the confines of a positive trend. And that's, been the case for a number of months now. The S&P moved, the 20-point chart moved back into a positive trend back in April, and we've seen near-term sell signals developed on the chart. But what we haven't seen, moves into negative trends for either the S&P 500 itself or a majority of individual stocks, as we continue to see a majority of S&P 500 stocks are in positive trends today.
Absolutely, Jane. As you mentioned there, looking at the 20-point chart of the S&P, still maintaining a significant distance above its positive trend line, which has just been furthered over the past few weeks here as we've headed down the final quarter of the year. And in looking at some of the indicators that we track, some of the underlying movement of the stocks within the S&P 500, one of those being the percent positive trend for SPX, or PTSPX as it says the ticker there on the site, which as a refresher is going to be taking a measure of the percentage of stocks in the S&P 500 that are trading above their bullish support lines or in an overall positive trend. We use this as kind of a more intermediate to longer term participation indicator to see, okay, we understand the index is maintaining its distance above its trend line, but how are the stocks within the index doing? And taking a look at this particular indicator, we saw it reach the match multi-year highs back in June of this year, up at that chart level of 82%. So 82% of stocks were trading in an overall positive trend as of June of this year. And then we began to move a little bit further south, got a reversal down in July, reversal back up in August. And then with the volatility we saw come into play in September, the chart reversed back down into a column of O's after making a lower high and then falling to a level of 66% on the PT-SPX chart. With the increased participation, the increased upside participation we've seen over the past week or two, saw this chart actually reverse back up into a column of X's at 72%, following trading there on Friday. And so, as Jay said, even though we reversed down from that high level, fell down to that 66%, still had an overwhelming majority of stocks in the S&P 500 that maintained their position above their bullish support lines. Even though we did see the participation decline a little bit with the volatility, it's certainly a positive sign to see this positive trend indicator reverse course and move back to the upside there, and the column index is at that 72% level. Other indicators, other positive trend indicators were tracked on the platform. Also saw the PTMID, the positive trend for the S&P Mid-Cap 400 reversed back up into a column indexes after trading on Friday. And we saw the bullish percent charts measuring the percentage of stocks on buy signals. Each of those reversed back up into X's prior to last week. So seeing this follow through back into more charts moving back into positive trends for large caps and mid caps, seeing those charts reverse back up into X's is certainly a positive sign. One thing we're still waiting on is if we take a look at some of the other indicators that have more kind of small cap representation. PTSML is still sitting down in a column of O's, waiting for that to reverse back up. And then also the percent positive trend for the NYSE, the broader percent positive trend for the New York Stock Exchange, PT-NYSE, is still sitting in O's at that 50% level. And in looking at some other times where we've seen this indicator had similar movement, we saw the PT-NYSE, the chart on the right, move from that very low level down at 8% that it reached there in March, all the way back up to 56%, reversed down in July, back up in August, and now back down in September, and sitting there at that 50% level, at least on the chart. And it is important to note that in order for the chart to reverse back up into X's, we need to get to 56% of stocks in a positive trend. And we're about one box away based upon an intraday reading of just over 54% through market close on Friday. And in looking at some other historical times, we saw a pretty similar picture. This 50% level is that kind of line of demarcation. Jay said you'd like to see the overwhelming majority of stocks trading in a positive trend. And so having the chart drop beneath that 50% level is really the point to keep an eye out for. So still sitting at that 50% level is certainly an interesting point to note. And in prior times we've seen this move is taken back to July of 2009, chart moved up to a chart level of 56%, reversed back down into O's at 50% in July of 2009, and then moved higher from there throughout the rest of the year. Also saw some similar movement there in 2012, in June of 2012, falling down right down to that 50% level, and then reversing back up into a column indexes later the year to continue higher. So we are sitting, as I said, just a little bit less than a box away from reversing back up into a column indexes on the PT-NYSE chart. But definitely one point to keep an eye out for as we head through the next few weeks here, Jeff.
Yeah, that's great. I mean, you certainly look at that, and that 50% level has been a very notable level, and generally speaking, when that specifically for PT-NYSE, PT-SPX as well, but specifically for PT-NYSE here, that's been a pretty good level, and historically when you've seen those indicators north of 50%, it has been a generally positive sign for the market. And all that's saying is that a majority of stocks are in positive trends. You see, you see the NYSE a little bit lower than, say, SPX is. And a lot of that has to do with the composition of those inventories, with the SPX obviously being more large cap focused versus the NYSE, which has a bias towards small caps and more value oriented stocks just by nature of those individual names out there. But when you take a step back and you look at the S&P chart still in a positive trend, PT charts still positive. You look at Dolly, kind of broad asset class rankings, and U.S. equities has moved back to number one, having done so back, gotten back to number one back in August of this year, and then continues here over the course of the past few weeks, has continued to pick up net new buy signal. So out of the relative strength rankings right now, you see domestic equities has 260 relative strength buy signals, and that's about a quarter of all the buy signals that are up for grabs in Dolly. So right now, U.S. equities has the most relative strength buy signals, or as we refer to them sometimes as wins in the grand scheme of the relative strength matrix ranking system, with fixed income being number two in terms of its buy ranking at 226 signals. And so domestic equities being at 1, when we drill down and look underneath the surface, and we see obviously the strength in the market has been very clear this year in terms of leadership within U.S. equities, as growth stocks and very specifically large cap growth stocks have really dominated the market and have been instrumental in terms of the market performance this year, with large cap growth being number 1 in terms of the size and style, mid cap growth number 2, and we just saw small cap growth move back up to number 3. Large cap blend is sitting there at number 4, and they're net tied in terms of their actual number of buy signals. Small cap growth edges it out in terms of kind of the tiebreaker there. But small cap growth and large cap blend have been kind of going back and forth between 3 and 4 this year. And so right now, small cap growth seeing some near term improvement recently in the small cap space, seeing it edge out large cap blend. And we continue to see the value styles based by and large down towards the bottom. And so, there's obviously a lot of talk out there. Value stocks have gotten beat down the most, and we have seen some near-term improvement from obviously small cap space. But Ian, when you look at that from the asset class group score page perspective, when you drill down and look at some of the group scores, what is that showing in terms of is small cap and value ready to come back and outperform some of the other areas?
Yeah, absolutely there, Jay. And taking the group scores page gives us another kind of lens into a broader picture of the market, at least on that default macro view that we come to right when you first would go to the particular page on the platform. And then looking at that view, you see a pretty similar picture. As you said, there with Dolly domestic equities up at the top of the rankings, further distancing itself from the other asset classes over the past few weeks. Seeing a similar picture for the broader asset class group scores macro view. You'll notice that the only groups to possess an average score greater than 4.0 are all equity-focused areas. The S&P 500 index funds, the highest average score out of these groups examined, and an average score of 4.73, and a pretty positive score direction for most of those areas as well. Some fixed income groups are still maintaining relatively high score positions, mainly those more typically correlated with equity improvement, corporate bond high yield. It being one representative you see there up at the top. Fixed income scoring a little bit lower, and then you have cash down in the bottom end of the rankings, with the money market percent rank still at 7%. U.S. equity core percent rank, which measures the relative position of that S&P 500 index funds group, which is at a percent rank of 92% out of all 135 plus groups that we track on the group score system. So still not seeing a high score position of many of those domestic equity representative groups, low score position of many of those other more kind of defensive areas, such as the cash U.S. money market group that you see there down towards the bottom. But as you said, when we're taking a look within some of those areas within domestic equities, one way to do that is through the U.S. styles group view that we have on the page. And in doing so, you can come in, you can sort that page either by score, which is going to default to, which you still see large cap growth having the highest score direction out of any of those groups that we track there in this U.S. styles group at an average score of 4.96. But if you look at that page by a directional sort rather than just the average score, you see some of that near-term outperformance from small cap that Jay had touched on there, from that we've seen from the Dolly page, with that rising back into the top 3 of that group score, or that Dolly representation, displayed here as well, with each of the top 4 scoring size and style areas, or the 4 small and micro cap groups that we have tracked there on the asset class group scores page, with microcap actually showing the highest score direction out of any of these groups, with the average direction there of 2.61. The other kind of important things to note are that the growth groups still outscore each of their respective other style areas within each size classification. So you have mid-cap growth outperforming the mid-cap value, large cap growth outscoring the large cap value, and still small growth, even though we've seen some near-term improvement from small cap value with that strong score direction of 2.36. Still out of favor relative to these other areas from an average score perspective. down at that area above 3.20. So definitely seeing some of that near-term increased participation and outperformance from the small cap space, but the growth camp is definitely still going to be in favor from a broader perspective, certainly from that score there across each of the size classifications, and similarly reflected of what we see there in Dolly.
Yeah, that's right. You know, I think what's interesting too on that is, you know, all of the style boxes, with the exception of mid-cap value, are scoring above 3. And I think that, you know, certainly speaks more towards just the breadth that the market rally has endured over the past few months. As you know, a lot of areas have participated to the upside. The growth, as you mentioned, is still in a leadership position right now, but there really has been a broadening out of just the movement that we've seen within the market to see some of those small cap in the even value minus mid cap value get back above scores of 3, which is what we want to see in terms of groups that we're investing in. So, you know, certainly positive signs. And, you know, as we continue to move through the month of October and get closer to the U.S. presidential election, we'll continue to monitor these rankings for you. If you have any questions, if there's anything that we can help do in terms of where within that the different styles we want to invest or looking for ideas, we can certainly help walk through any of that for you. So please contact us. Our contact information's on the page right there, phone number, email address. If there's anything we can do to help you, please let us know. With that said, though, as always, we appreciate you taking time out of your day to hear and join us. And so appreciate it and look forward to talking to you next week.